Hi, this is Carl Gong. I'm using this video to demonstrate my R programming skill. So I'm looking at a project I did last spring when the stock market was looking good and the discussion was, are we headed towards a recession and possibly a bear market? So essentially, the stock market had been in roughly a 10-year bull market, and it looked what they would call a tired bull market. So if we were to move further along, we would get into a bear market or a recession along the way. So in anticipation of a possible coming recession, I thought it'd be good to take a look at the stock market and how it performed during the last bear, bull, or business cycle, as I would call it. So my thoughts were at the time that the market is made up of many different sectors, and there should be hopefully some sectors that are going down when the market is basically in a bull stage, and vice versa. So in this case, as a bear market comes along, there may be sectors that would be moving ahead in spite of this. And we hear the usage of basically rotation into defensive stocks when you get into essentially a bear market situation. So I wanted to check if this is true and what those particular sectors would be. So as part of this, I'm using R, and as part of using R, I'm using RStudio as my IDE, or Integrated Development Environment. This provides basically a very good place where you can generate the code, test your code, and also put in comments. And as part of this, I basically can do a R Markdown document. So this is what the R&D stands for. So you can initially start a new job or new project by going into essentially File New, and you can see you can just do R script, or you can do the R Markdown. So under the R Markdown, you have your choice of 3 possible output file type. And let's bring that up quickly. So you can identify the title, how you want to title this project, and of course, you being the author. You can have the output go to an HTML, a PDF, or a Word document. Now, obviously, the HTML will essentially send a document that can be posted on the web, and a PDF can be sent to many other people to basically open up with Adobe Reader. I like the Word document because it now becomes a document that Microsoft Word can open up, and you can manipulate and continue editing on that and cut and paste, etc. on the Microsoft Word document, and you can then send it to others. So the R Markdown I'm going to be using essentially is Word. So I would have clicked Word and say OK, but since I've already got the document here, I'll cancel this and just work with the one I have. So you can see I titled this one Regression, and there's the author, the date, and then this is the output that I'm going into. Now, as part of the R Markdown, it basically requires knitting or stitching basically the various pieces together. So they call it knitting here, but that's basically stitching together pieces, and it's a nice acronym to be used with it. And again, this project is to analyze the correlation of the different sectors within the S&P 500 against the S&P 500 index. So I'm looking at these correlations and relationship over time during basically bull and bear market situation. So I'm going to take a look at the weekly sector market change or sector area change versus the S&P 500 weekly price change. and then I'll identify what kind of correlation there are, and I'll use basically the last business cycle. So the first thing to do is identify the business cycle itself. So one of the things I do is I basically done some analysis into what is a business cycle. So essentially, I've identified from basically this specific website, which is the NBER, or National Bureau of Economic Research, which is a federal government website. So if you were to click on this, you would see this. And as you see here, this is National Bureau of Economic Research. There's a section called Data. Within the data, you can see you can have these various information, business cycle date. And you get other things such as the population survey information and other vital statistics if you wish to look and download that for analysis. So I was interested in the business cycle date and how they identified it. So I'll close this data sheet. And you can see this is the U.S. business cycle expansion and contraction. You can download a PDF version, and you can download the data into Excel if you wish to. But you can see business cycle reference dates. So this identifies essentially the peak and the trough, and they go by months because the data is basically updated monthly economically. So you basically have a month and a year, and you can identify by the quarter, and they use here in parentheses the quarter. So December is obviously the fourth quarter, June is obviously the second quarter, and so on. April, they give the first quarter. I would have thought that was the second quarter. So let's see where else. March is first quarter, March is second quarter. Interesting. I think this might be a typo here. April probably is second quarter. Anyway, you can take a look at this data, and then if you look at the very bottom, you see the latest one. So the latest one has basically March 2001 to November 2001 as being one of the business cycle, and this one would have been essentially the big downturn of the NASDAQ, basically. So besides the NASDAQ, the S&P 500 also went down, and that lasted for 8 quarters. The one before that was July 90 to March 91, and that was essentially an 8-month also downturn. And of course, the latest one right now was the December 2007 to June 2009. And essentially that was the big financial meltdown, which lasted 18 months. So I'm sure they're going to be looking at in the next month or so, the next when the peak was, because now that we're down 30% or more, and we are looking into a slowdown right now, it looks like we're going to get an update on this. Now, as of today, which is March 24th, they have not had another meeting yet. So, latest announcements from the NEBR Business Cycle Dating Committee was last dated 9/20/2010. So it's been 10 years. And I think it's now time for them to start getting together to decide when the peak was. So when they do decide that, you also get information like at the very bottom, announce date and link to announcement period, for instance. So January 1980, they announced the peak. June 2009, they announced the trough on September 20th, 2010. So, like I said, I think they're going to be looking at defining the peak from this recent events we've had. Okay, so that's essentially the business cycle. So I have listed here the last business cycle. So it basically runs from December 2007 to June 2009. So I figure I'd go backwards to the beginning of the January period to begin collecting data to get essentially this trough, and then to, of course, capture up to today's date. In that case, it was back in 2019. So the data I would collect essentially, going back here, so I'm collecting data from January 2007 to today, and I'm importing the data. And first of all, source of data. There are many sources of this data, but I find that a lot of websites do not have a very thorough listing of data. And I had to go back to Yahoo Finance, which I've used 20 years ago, which had probably the most definitive database that actually has daily records for all the stocks, stocks and indices and ETFs, and have basically a good collection that they continue to use. So I remember using them back 20 years ago, as I mentioned, but newer data, apparently most websites are only keeping maybe up to 5 years of daily data and possibly 10 years of weekly data. And before that, they would be used monthly data. So if you're interested in doing significant research into stock price trends on a daily price change, or some other more detailed research of the past, you'll probably have to use the Yahoo Finance website. They will be under essentially the quote section with historical data, and then you can pick the range you want. Most financial institutions, such as E-Trade and Merrill Lynch at the time, and Fidelity and TD Ameritrade, etc., have historic data capability, but you'll probably find them somewhat limited. So your final place of resources would be the Yahoo Finance website. Okay, so here I'm going to import the data, and to import the data, I have to basically load a library utility, and of course this particular one is called readxl. So as you can expect, readxl could be reading CSV type files. Another popular utility used essentially is tidyversa, so you can also load which has a bunch of other routines that are utilities that are of use. So I go ahead and bring that in anyway. And the first thing I do is I want to go ahead and create a matrix, and this essentially is a matrix of zeros of 646 rows, 13 columns, and 13 columns to identify are based on the 13 sectors I want to go ahead and input for my analysis. So the sectors are basically concatenated here, and these are the data I'm going to read in. I'm using basically the sector identifier used by Standards & Poor's. So the ETF that are used here is XLK for the technology group, and XLV for the health group, and then you have the I for industrial, B for basic materials, U is for utilities, P is consumer staples, Y is consumer discretionary, E is for the energy, F is for finance, and then I added IYR, which is not X, but it's essentially the real estate ETF. And again, all of these are ETFs, so you can buy and sell them as stocks. And then for the Standards & Poor's, I'm following the index using SPY. And I added GLD for gold and AGG, Now, this is called AGG1 here, but it is AGG, which is a composite bond fund or bond index. It's basically an aggregate of all maturity date bonds. And here I'm creating a for loop to basically loop through the sectors that I just identified up here, and I basically read each into a matrix called df. So I'm reading using read.csv, and I'm using paste to attach two texts together, and the text is essentially the y, which is the variable in here, scanning through essentially each of the ETF, concatenating with a .csv, and it's separated by essentially a blank. So it's basically xlk no space .csv, and it has a header in it. So once it reads that into the matrix df, and then I will essentially strip out just the one piece, and let me show you what these particular CSV file looks like. So if I go here, this is essentially a CSV file imported into an Excel spreadsheet. So you can see here, let me go to the very top. You basically have a header information here, and this has basically the date, open, high, low, close, adjusted close, and volume. And then it's followed by essentially the date. So this is essentially the data type I would read in, and it starts with January 1st, 2007. And pretty much all websites that download the quote data, you'll see open, high, low, close, and adjusted close. Now, adjusted close is really the data you want, because the adjusted close basically adjusts for interest/dividends or possibly stock splits, etc., that the stock would have undergone. So you could basically get the corrected value of the stock with the adjustment made. So if you have a stock that's split, it will essentially double the value. So you get basically a higher adjusted close as a result of that. But in real terms, it really hasn't changed. So while the price would have changed by reducing it half, the actual adjusted close value would still be as if the stock never split. So that's a good way to maintain the value and use for comparison as to growth of the particular stock. Okay, and again, the adjusted close is really what you want, so that is the sixth column, yes. So if we go back to the spreadsheet, you can see we're reading the sixth value into our matrix. And another thing is, matrices and lists are based off an index of 1. Python and many other programs use an index of 0. So you do need to keep that in mind. So again, we're reading the sixth column into essentially, in this case, when we have n equals 0 to start with, for the very first one, n equals 1, it would be essentially the first column of data 1. So the data 1 matrix will basically include XLK, and then as we loop through to the second value, so y will essentially be XLV now, and XLV.CSV will be read. And you take again the sixth column of that will go into essentially the second column of data 1, and read all the rest of these in. So essentially you get 13 items being read in, and you fill up the matrix with the weekly price data. And now I create a data 2 because I know at some point I'm going to be subtracting data 1 from data 2 to get the delta or the change in the price of the security from 1 week to the next. And so I create a new matrix, essentially one with essentially prior week data. So data 2 basically will start off with essentially the same first row, but then the second row will be equivalent to the first row of the first one, so that when you do the subtraction, you'll essentially be subtracting the next week data from the prior week data. And you create a matrix then by subtracting it of delta. And of course I divide it by delta 2 so that I can get a percentage rate change. So you're looking at the rate change from 1 week to the next in percentage term. So let me go ahead and slide this down a little slow. Okay, so the next thing I do is once I have the data, I can turn it into a data frame. So the data frame will essentially be the data plus a row header and a header for the columns. So you can name the columns and you can name the rows, and that's what we'll do next. So df1 is data frame of the data 1, which is the original matrix. The delta is df2, so delta is turned into a data frame called df2, and now we create the header. And as I point out before, the first column is called technology, next one is health, industrial, basic material, utility, consumer stationery or consumer staple, consumer discretionary, energy, finance, real estate, S&P 500, gold, and bonds. Then I will name essentially the columns of DF1 to this list of sector 1. Same thing with naming the columns of DF2 and calling them also the same sector 1 headers. And I will create essentially the labeling for dates by essentially using the date function. So I basically assign date of 2001 January 1st to the start date. I assign date of 2019 May 15th to the end date. And then I create a list using the sequence dot data function using the start end date, which you can see here, start and end date, and the by, in this case by 7 or 7 days per week. So essentially you create a sequence of dates starting with January 1st, 2007, then January 8th, 2007, and January 15th, etc. And then I go ahead and assign that to essentially the column called date in 2001 for DF1 and DF2. So if I run this section here, you'll see all this run through, get all the assignments, open up the libraries and attach the library. Should be much faster, but I have a few things running on this PC right now. And there's inputting the library now, doing the matrix, assigning the sectors, and now it's going to run the for loop. You see over here. And there's the for loop completed, and now it's basically creating my data 2 matrix. And you can see the objects are being the global variable, how they're changing up here. And now it's doing the column name, and it's doing the date list, and now it's done. So that's taking a little while, so I think I will go ahead and cut that out from actually running these little routines. Okay, so as part of my analysis, the next thing I do is I do a summary of this. So the summary basically provides you with statistics, and it'll do it essentially by columns. So you can see here it gives you the technology header, gives you the minimum, the first quartile, the median, the mean, the third quartile, and the max. Those are the basic statistics that they can summarize for you. One of the things to look at here is the mean. So the mean here is basically 0.002, and this is a weekly change. So you can think of it as being 0.2% change per week. So if you were to look at that over a 52 weeks, you would multiply that number by 52, and you would get roughly 10.9 or 11. So roughly you get about 11% change on average. So if you run that for an annual change, that would be about 11% annual change, probably a little higher. So if you take a look at the S&P 500, you can see the mean here is 0.001773, or 0.17%. And if you multiply by 52, I think you get 9.2. So you get roughly 9.2% change for the S&P. Technology looks like it's running a little higher. So this gives you an idea of what's probably changing a little more. And there's another way to look at it a little better. So actually I wanted to bring back the bond. So let's take a look at the bond also. So you can see stock was basically 0.17% change per week. Bond, you can see the mean here is 0.007647, or 0.07% or 0.07% change per week. So you multiply that out by 52, and that runs roughly 4%. So stocks was gaining roughly 10-11% change, or in this case I guess 9.2 was what I said was the Standard & Poor's change, and bonds was running about 4%. So again, you're getting basically an extra 5% getting into stocks than you would be into bonds. So that's a little basics about the difference between bonds and stock. We can now take a look at some Boxplot, which will show you this data particularly in a different fashion. So here's the Boxplot of the first 4 header, and then the next 4, and then the last 5. And you can see here there's a plot of essentially the first grouping, which is technology, health, industry, and basic. And you can see the mid-range here is pretty tight. The first quartile is essentially the bottom part of this box. The mean or 50% medium point is the solid line in between the box, and then at the top of the box here is essentially the third quartile or 75% point. Now this is a box plot, so you have a few other additional information here, and the line here represents essentially the interquartile range, which is the width of this box times 1.5 from the third quartile. So better way to explain it for me would be to show you from a website on understanding Boxplot. Here we go. So the points you see out on the edges are essentially considered outliers. The minimum setting to determine outliers essentially is this interquartile range, which is the range between the 25 percentile, which is the quartile 1, and the 75% point, which is quartile 3. So you take basically 1.5 measure of the interquartile range from essentially the 25 percentile towards the minimum to determine anything greater than that would be an outlier. Same would be essentially at the max point. You take the same interquartile range, add that to basically the third quartile to determine what that value is, and anything greater than that again is considered outliers. So that's the basic definition of what a box plot is. So again, here you can see all these points here are considered outliers. All these points here are considered outliers. And you can see the range of the technology is a little higher than the range of the health, except there is one point in the health that's much further off. So that indicates there's something unusual going on here. But let's take a look at the rest of it. So if you go to the next one, so utilities, again, is fairly tight except for one spot. I'm believing this is the one point where everything was down almost 20%, which is quite a lot in 1 week. However, this last week we've just had might have matched that. So I haven't added this last week into the data, but it would be interesting to see. It probably just fits in that area. And consumer staples is a very tight range and doesn't basically have a extremely high range of span. Consumer discretionary has a higher range, and consumer energy has a large range also. And now let's look into the other ones. This one I kind of like because it has essentially everything I wanted to look at. If you want to take a look at the finance, you can see the finance ran an extremely high broad range. Real estate stayed fairly typical like the others. This is the S&P 500, so you can see both these are very similar. While real estate is closer to S&P 500, but finance is much greater range. And you can see gold is a fairly tighter range, and bonds is even tighter. Now another way to look at this data is basically to look at the correlation. So in this correlation, you basically have all 13 items correlated against the itself and the other items. So for instance, you can see technology correlated with technology would be a 1-to-1. Health correlation to technology is roughly 0.7. You can see it's vice versa also. Technology correlated with health is 0.7. So if we just want to compare against the S&P 500, we can just scroll down to the S&P 500 here. Look at this range here against each item. So technology correlates quite well, 0.91. Health is at 0.81. Industrial looks very strongly correlated at 0.93. And basic material also. And you can see utility is only correlated by 0.61. Again, correlation of 1 is perfect correlation. Correlation of 0 means no correlation. And correlation of negatives are essentially inversely correlated. So if you have a -1 correlation, it would be inversely correlated. And that's really what I would like to see, because then those are the stocks you would prefer, or those are the sectors you would like to invest in a down market. So as the S&P 500 goes down, they would go up. And you can see the only thing negative here was gold, and it's just barely negative. So the correlation is just barely negative, which is not great. But you notice the bonds is almost non-correlatable also. So you have basically gold and bonds as the most uncorrelated things to the S&P 500. So those would be the alternative investment you can invest in, so that as the market goes down, you would not be losing money as much. Other items, you can also see real estate is at 0.74. And so if you were to look at utility, real estate, they seem to have a positive correlation to S&P 500, and they're reasonably correlated. And so those would be the two lowest correlator here. I think I see consumer staples also. So again, in down markets, as you might expect, they've been telling us to buy utilities, consumer staples, and real estates. And these are the least correlated with the S&P 500. So that's probably how it ended up being picked. Or they're that way because people invest in them. Again, the stock market is basically a voting machine of the stockholders or the investor, and they vote on what they want when things change. And what you're following and looking at is what the trends are of what they're selecting. So again, it turns out quite interesting that while if you did pick utilities, consumer staples, or real estate, you still would be highly correlated to the S&P 500. The best thing you could invest in looks to be gold and bonds. So that probably would be your strategy in a down market, would be to go to gold or bond so you don't lose as much. You could go to consumer staples and others, but you'll still be losing quite a bit. And here's another way to look at it. Now I'm going to do some plotting of the data. So what I'm going to bring in is the plot utility called ggplot. So again, I'm using the library function to bring it in. And I basically assigned the variable a with ggplot with the data frame I'm going to use, and I'm using the aesthetics to identify which column is the X and which is the Y, and I'm adding basically points to the graph to identify what I want. So I want basically the color blue and the size of it, and the Cartesian coordinate limitations for X of essentially 0.2, minus 0.2 to plus 0.2, same thing with the Y limits. And then I'm adding labels. So essentially with ggplot you can just do add, and you can keep adding on more things to it. The labels is title SP500 versus technology, and Y of course is the technology, and X is the SP500. So once I have this assigned to A, the variable A, I execute the variable A, and it will essentially generate the plot. Same thing for B. I basically do the healthcare for the next one. Doing the same thing, I change the color to red. Then I can continue on to the next one again, which basic materials, and I give it the color green, using the same, pretty much everything the same, and just changing the name of the title. So if I were to look at that, a little too fast. There we go. So again, the first one was technology. And you can see it's quite correlated very nicely. There is one bad point, or one outlier point, and that is the 20% drop in the S&P 500. Created a 15% drop in the technology. So surprisingly, it's not that correlated out here, but if you look in here, it looks very correlated. Now, what I had hoped to see is that on the negative side, things would be different. They would be less correlated, and possibly you get a different shape, maybe an S-shaped curve or something. But it looks pretty well linear correlated to me here. So this is technology. That's healthcare. And again, it looks very correlated here. And basic materials. And in industrial, same thing here. Interesting enough, again, industrial looks like it's only a 15% loss here. Yeah, they're not exactly the same plot, but they sure do look like the same between technology and industrials. And as we move on, you can see utilities are a little less correlated. It's more of a cloud in here, so it's not as well correlated. And consumer staples, again, a little less correlated. Consumer discretionary looks fairly correlated again. And energy still got fairly good correlation. Financial, again, not as correlated, but it does look like there are some steeper movement in this one. And it's a little more scattered for the outliers. And for gold, it looks like a blob in the middle, so it looks fairly highly uncorrelated. And aggressive bonds. Now there does seem to be well, you might say there's correlation or no correlation. So it's interesting that it's just a tighter no correlation than the gold. Again, gold spans across here, but definitely with bonds, it has almost no change. There was one correlation that was quite interesting. Again, that could be something what we're experiencing right now also. We have a tremendous drop in the stock market, but we're also having a bond market drop also. I believe we've had about a 15% drop also in the bond market. Okay, so based on this analysis, on a down market, it seems to me you want to be moving into bonds and away from stocks. And there doesn't seem to be any sector. And I had hoped that in one of these charts I will see a negative correlation, that is a scattering of points in this direction here. But as you can see, all the correlation seems to be positively correlated, and the magnitude might be different. So the next thing I wanted to look at was create basically a line fit through these dots to see how they correlate and what their linear coefficient would be. So the next thing I do is, next thing I did is basically look at the Standard & Poor's itself and look at the data over time to see what the weekly change was. So again, I created another plot I use basically the delta data, and I basically use the date for the X, and the Y would be the S&P 500. So you can see I basically use a linear instead of a point. So I'm basically creating a line plot now. And I label this title here of S&P weekly change. And then I will also plot DF1. So DF2 was the delta matrix. DataFrame DF1 was essentially the original data itself. So plotting that shows me what the actual price per week was. And again, that's creating a line. So below here, you see first the delta plot here. And you can see there's this one point here in October where the market dropped down 20% in a week. And it did follow that with a plus 10 and plus 18 or so. So again, this is also what we're experiencing. So I'm talking to you on Tuesday, the March 24th. And as of today, we just got a 11% bounce in the S&P 500 and in the Dow. And it looked like it had just followed a big negative drop also of 20%. And these are weekly changes, so we're not at the end of our week yet. So for the week, we may end up neutral, but I would have to go back to the what looks to be the 2009 time frame as to how big a drop that was on a daily basis versus a weekly basis. But what we're seeing right now in basically the third week of March is beginning to look like what had happened in what was probably October in 2008. So it is not unusual to expect these big bounces, and you can see the oscillation is quite good, quite high. It didn't calm down till we got into 2009, and I think it was roughly March, April time frame that it calmed down. This one looked like it kept going on, but March was here, and this was like June. So by June, it had basically calmed down. And you can see we've had bumps along the way also of a 10, not quite 10%, looks like 6 to 7% change. So this is not unusual. So let's go back and take a look at the S&P. So this is the actual S&P 500 index weekly price. Again, the bear market looks to have started around October in 2007, running to roughly April of 2009. So it ran basically almost 18 months. And I believe that was the list of the peak to trough that was listed in our business cycle also, somewhere around there. Actually, I think it was December to June. So there are a couple of months. So we're offset a little bit. Again, the minimum of the market was probably in March. And if we look at the business cycle again, so again, the business cycle was December 2007 to June 2009. So the market looked like the, the, the beginning or the peak was more like October, and the bottom looked to have been around March of 2009. I think it was mid-March was where it essentially the trough was. So again, the peak and the trough of the business cycle is off by a couple of months from the actual market. So the market is the leading indicator. So we might be looking for the market to bottom out before we actually get out of our recession or correction, whatever we want to call this business interruption we're having with the coronavirus. Okay. So again, this is what the weekly price change is. So I wanted to see specifically, as I pointed out earlier, all the changes look to be linear across positive and negative. So it seems to me the market doesn't care whether you're in a bull or bear market. You still act accordingly with each of the security types. So specifically, I wanted to take a look at the correlation coefficient of, again, the market change. So again, let's go here, and what I'm doing here is creating essentially a linear model and putting into essentially the variable called tech.model. So I'm creating a linear model with a Standard and Poor's, which is technology versus the Standard and Poor's. So this is your Y, this is your X from the DataFrame DF2. And I would do the same thing for the next one. So by creating the technical model, technology model, and then by executing tech.mod, I basically will plot it. So or I would cause it to be analyzed. Basically, I'm analyzing it here and assigning the results to tech model, and then I'm displaying the results, tech model. And then I'll do the same thing with the basic material versus the S&P 500. And also, again, displaying the results. Same thing with financial, industrial, etc. So if I look at the model that's printed out, so again, I call the linear model. And basically, the intercept is 0.0007. And the correlation coefficient is 0.9. So essentially, actually not the correlation coefficient, but the coefficient of to the x-axis is 0.955. So basically, the S&P 500 is the value of S&P of the x value. So if the S&P moves up 1%, the technology stock will move up 0.95%. So basic material has a X coefficient of 1.1. So for every 1% rise in the S&P, the basic material will rise 1.1%. And this is the one that's most interesting. So for financial, the linear coefficient is 1.4. So that for every 1% rise in the S&P, the financial will move up 1.4%, or 40% more than the S&P 500. So this has your highest sensitivity. So if you are looking for growth during the bull phase to come, you would look for this essentially to be something you would buy into. Same way, if the stock is going down, you would want to get out of this first, so you lose less. Whether that's as a result of the market actually doing this or not, because I know the market tends to say financial are the better things to buy early in the bull market, because rates change first, and the banks basically collect your money because they lend the money out at a lower rate still. So they're making more money at the time. So people tend to buy financial at the early bull market as the Fed fund rates begin creeping up. And here for the industrial, you are getting a coefficient, the S&P 500 of 1. And for energy, it's 1.5. For health, it's 0.74, which is a lower rate. So you would not want to be buying health at this time. However, the trade-off is the health probably has a higher dividend. And you can see consumer staple has a very low rate, 0.56. So again, if you had bought health or consumer staples, you would lose less on the downside if you had these, but you would still be losing. Consumer discretionary, again, it's 1.08. Utilities, again, it's only 0.56. So between the consumer staples and the utility, you would lose less. Real estate still fairly highly correlated with a slope of 1.07. Gold again is uncorrelated. And bond is very loosely correlated by 0.04, the coefficient. And again, the correlation coefficient was pretty much nothing also. So what would be interesting is to do the same analysis, but let's just look at the bear market. So if I go back to the plot I showed earlier, it ran from October 2007 to March of 2009. So I'm going to filter this by creating a third data frame using a filter and taking essentially the original delta data DF2 and filtering it into date range essentially between October 1st, 2007 to essentially March 10th, 2009. So after filtering it and then plotting it, so this is plotting the data again. This time I'm plotting DF3, and I'm only looking at financial, real estate, gold, and bond, and see how they perform against the S&P 500. So if I looked at here, so this is the financial, and you can see during the down period, you can see more points in the negative side of the S&P 500. So this is essentially the dividing line of S&P 500 is 0. You got probably more data points to the left than you do to the right, but it still follows a fairly steep curve. So if I were to look at this, I'll look at it a little closer and do a linear fit on it to see what it does. But I'm also looking at the real estate. Again, it looks pretty much the same on the positive and negative side and as the previous chart we see. And again with gold, and again with bonds also. So now I do the linear modeling again, and I'll call this FIN2, real estate 2, and gold 2, and bond 2. And when I print them out, I now have the financial at 1.66. Again, the previous number was 1.4. So it seems like it's a little more sensitive. But again, this was the financial crisis. So it may have been exaggerated because of being highly involved in the market at the time, that as people got scared with the financial crisis even more, they sold off more. And as they thought it was recovering, they bought more. So possibly you have a higher sensitivity, but it does seem to maintain a fairly high linear coefficient. So between 1.4 and 1.66, this will be, to me, the area to get out of first or to get into first, depending on the market. Again, real estate, 1.07, pretty much the same. Gold, again, little less correlated, a little more negatively correlated, which is good, which is what you want. And for bonds, a little more correlated, 0.14. So again, every percentage S&P goes down, bonds only goes 0.14 or 0.14% down. So again, looking at the correlation coefficient, you get pretty much the same thing. Again, health is low, utility is low, consumer staple is low correlation. Financial, that's basic material. Let's step down a little further to S&P. Okay, health is 0.81, not as low, but utility is 0.76, is quite low. And if we go further down, real estate is 0.81, and again, health is 0.81, and yeah, health, real estate, utilities, and consumer staples is 0.84. So they're still highly correlated. And again, the lowest correlation is gold and bonds. Bonds is still somewhat correlated, but at 0.4 versus anything, I would say anything above 0.8 is reasonable correlation. Below that, you start having less correlation, but gold is obviously the number one. It's negative correlated, so that's always good, and that's what you're looking for. So I would have said you go to gold and you go to bond when you're basically in a bear market. So we have been at this point in a bear, but I think after the market has gone down 37%, that there's possibly more upside than there is downside. So it is a good time to be buying, and I have also already been putting money into the market on the way down. I basically have points at roughly 8 to 9% that I started doing some buying, and when it got down to where it's more bullish, or I should say bearish, closing to 20%, I bought more, but I still left a bit in cash, so I put more in at about 35%. My next target is 40%, and if we ever get there, 50%. And if we get to 50%, that's pretty deep bear market, but bear market runs roughly between 30% to 50 to 60% at the worst. And because the coronavirus is only a temporal thing, and what they call a exogenous event, it will go away and everything will return back to normal once it's gone. The question is it going to go away in 3 months, 6 months, or a year? Based on a long-term horizon, I'm looking out 2 to 3 years or further. I would be buying right now for that time period. And I will list a bunch of things later on what could be bought, but at this point, I would be looking at a lot of things and buying good companies that will survive the next 3 to 4 months. Okay, I think that provides an update using R and doing some of my analysis. So I hope you enjoy this, and if you have any questions, you can email me. You know where to get a hold of me. Thanks. Bye.